Strategy Management Series. Video number 72, Strategy Formulation. Step 6, Strategy Selection, the Grand Strategy Matrix. Welcome back to the Ready MBA series on strategy management. In our previous videos, we have been discussing strategy selection, the sixth step in the strategy formulation process. This step consists of identifying and selecting courses of action that a company may choose to achieve its strategic intent, mission, vision, and objectives. To help define those, the planning team can leverage generic strategies and strategic frameworks. Generic strategies are fundamental approaches that businesses adopt to gain a competitive advantage and position themselves effectively within their industry or market. Strategic frameworks are analytical tools that help the planning team visualize the specific conditions in which the company finds itself, and based on their results, enable the company to identify potential strategies to be executed. In our previous episodes, we covered different groups of generic strategies such as Porter's generic strategies, diversification strategies, integration, cooperative and acquisition strategies, as well as restructuring and disruption strategies. These generic strategies help businesses make strategic decisions about how they will compete in the market, allocate resources, and differentiate themselves from competitors. In this video, we will continue reviewing different strategic frameworks to identify the most appropriate generic strategies to be considered by the planning team given internal and external market conditions. We'll explore another powerful framework for strategic analysis and decision-making, the Grand Strategy Matrix. The Grand Strategy Matrix helps organizations assess their business units based on two key dimensions: competitive position and market growth potential. By plotting these dimensions on a four-quadrant matrix, companies can identify appropriate strategies for each unit. Let's dive in and learn more. The Grand Strategy Matrix provides a structured framework for evaluating business units based on their competitive position and market growth potential. On the horizontal axis, we have the competitive position, which ranges from weak to strong. This position is determined by factors such as market share, brand reputation, customer loyalty, technological capabilities, product-service differentiation, and competitive advantages. On the vertical axis, we have the market growth potential, ranging from slow to rapid. This potential is influenced by factors like market size, industry growth rate, customer demand, and emerging trends. In order to estimate both the competitive position and the market growth potential for a business unit, a division, or a product, the planning team can use the following approach. 1. Identify relevant factors. Review the list of factors mentioned earlier, and identify those that are most relevant to your industry and organization. These factors should collectively provide a holistic view of your competitive position and of your market growth. 2. Quantify or qualify factors. For each identified factor, you can either assign numerical values, quantify, or use qualitative assessments, qualify, to describe your organization's standing. For example, you might use a scale from 1 to 5 or use terms like low, medium, and high to represent your organization's performance on each factor. 3. Weight the factors, optional. If certain factors are deemed more critical or carry different weights, you can assign weights to them. This step is optional and depends on your organization's priorities. 4. Aggregate scores. Aggregate the scores or assessments for all the relevant factors. This could involve summing up the numerical scores or considering the overall qualitative evaluation. 5. Compare with industry benchmarks. Consider benchmarking your organization against industry standards or competitors to add context to your assessments. This step can help validate your competitive position as well as the market growth. 6. Placement on the Grand Strategy Matrix. Once you have a consolidated view of your competitive position, use this information to place your organization on the Grand Strategy Matrix. The Grand Strategy Matrix divides business units into four quadrants, each representing a different strategic direction. Let's explore these quadrants and the corresponding strategies associated with them. 1. Quadrant 1. strong competitive position, rapid market growth, aggressive. The business units in this quadrant have a strong competitive position and operate in a rapidly growing market. These units are considered to be in an excellent strategic position and should pursue aggressive strategies to capitalize on their strengths and leverage the market opportunities. Strategies suitable for this quadrant include market penetration, market development, product development, diversification, and strategic alliances. These strategies focus on expanding market share, exploring new markets, introducing new products or services, and forming strategic partnerships to enhance competitive advantage. For example, imagine a technology company with a business unit that holds a dominant market share in the smartphone industry and operates in a rapidly growing market. To maintain its strong position and seize growth opportunities, the company may focus on aggressive market penetration by capturing more customers and increasing product adoption. It could also explore market development by expanding into new geographic regions or target new customer segments. Additionally, the company might invest in research and development to introduce innovative products and diversify its offerings. 2. Quadrant 2. Weak competitive position, rapid market growth, competitive. In this quadrant, we find business units with a weak competitive position but operating in a rapidly growing market. These units face challenges in terms of market share and competitive advantage but benefit from favorable market conditions. The recommended strategy for this quadrant is to pursue competitive strategies that focus on improving the unit's competitive position and gaining market share. Strategies suitable for this quadrant include strategic partnerships, mergers and acquisitions, product innovation, market development, and market penetration. In situations in which the competitive position is really poor, companies may also consider divestiture or liquidation. Let's say a retail company has a business unit that operates in a rapidly growing market segment, such as online fashion retail. However, the unit faces intense competition from established players. To improve its competitive position, the company may consider forming strategic alliances with fashion influencers or other complementary businesses. It could also invest in marketing campaigns to enhance brand awareness and customer acquisition. Additionally, the company might focus on product innovation and process improvement to deliver a superior customer experience and differentiate itself from competitors. 3. Quadrant 3. Weak competitive position, slow market growth, defensive. Quadrant 3 consists of business units with a weak competitive position and operating in a slow growth market. These units face challenges both in terms of competitive advantage and market opportunities. The recommended strategy for this quadrant is to adopt defensive strategies that aim to maintain the current position and preserve profitability. Strategies suitable for this quadrant include related or unrelated diversification, retrenchment, restructuring, and strategic divestment. For example, consider a traditional manufacturing company with a business unit operating in a mature industry with limited growth potential. The unit faces strong competition from low-cost producers and struggles to differentiate its products. In this case, the company may focus on cost reduction initiatives to improve profitability and operational efficiency. It might also consider restructuring the unit to eliminate non-performing assets or divest from segments with limited potential. By adopting defensive strategies, the company can navigate the challenging market conditions and protect its profitability. 4. Quadrant 4. Strong competitive position, slow market growth, conservative. In this quadrant, we find business units with a strong competitive position but operating in a slow growth market. These units enjoy a competitive advantage but face limited growth opportunities due to market saturation or other factors. The recommended strategy for this quadrant is to pursue conservative strategies that focus on maintaining the current position, optimizing profitability, and exploring niche markets. Strategies suitable for this quadrant include related diversification, unrelated diversification, and strategic alliances. Let's say a financial services company has a business unit that operates in a mature market with a stable customer base. The unit holds a strong market position and has built a loyal customer following. To sustain its profitability and offset the slow market growth, the company may focus on market niche specialization by catering to specific customer segments or offering specialized financial services. It might also explore product diversification to expand its offerings and capture additional revenue streams. Furthermore, the company could consider strategic alliances with other financial institutions to leverage their expertise and access new markets. The Grand Strategy Matrix provides valuable insights into the strategic positioning of business units and helps organizations identify appropriate strategies for each unit. By evaluating competitive position and market growth potential, companies can align their business units with the most suitable strategies to maximize their performance and drive sustainable growth. However, it has certain limitations to consider. Firstly, it relies on a simplified evaluation of business units based on only two dimensions: competitive position and market growth potential, which may overlook other important factors. It also assumes that market growth potential and competitive position remain constant over time, which may not reflect the dynamic nature of markets. Lastly, the matrix does not account for external environmental factors or the potential impact of disruptive technologies, which can significantly influence strategic decisions. That wraps up our discussion on the Grand Strategy Matrix. We hope you found this video informative and that it helps you in your strategic planning endeavors. Don't forget to like and subscribe to our channel for more educational content on business strategy. Thank you for watching, and we'll see you in the next video.